On today's show, the long-term care update for February 2014, part 5 of this week's News You Can Use with nationally recognized long-term expert Maria Sarci. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Welcome to the show, Maria.
Thanks, Steve. I'm glad to be back.
I always love doing update shows, and long-term care, I want to give us a redux of what happened in 2013, kind of a summation, and then tell me, how do you look at standalone policies coming into 2014?
Happy to. So 2013 was a pretty interesting year in the long-term care space. We had many things that were changing within the industry. For the first time ever, carriers had moved to gender-based pricing. We had that announced somewhere around 2012, but it really hit the ground in 2013. So there was a lot of question, a lot of education that we had to provide, and at the end of the day, something that was a right move for the market. Because up until that point, there had been unisex rates across the board. And we know from experience that females tend to use coverage more than males, longer than males. And this change to gender-based underwriting, gender-based rates really had an impact.
Now, did you see premiums actually go down then for women, or were they higher? Or?
Premiums were higher. It's a great question. Premiums were actually higher. Same thing in the life insurance world. When you have males that apply for life insurance, their premium is usually more expensive than their female counterparts. So we saw the same thing happening in the long-term care space. And at first, there was a response from the industry of, oh my gosh, what will this mean? You know, and if you've been in the industry long enough, you tend to have that question raised time and time again. And the reality is we're evolving, and we shouldn't be afraid to evolve. We shouldn't be afraid to change the way that we approach our business, because now we have intel behind us through claims experience that shows us where we want to be. And gender-based rates were announced in 2012, happened in 2013, and I think that that dust is pretty much settled. So going into 2014, we'll see better understanding around it. I think that agents are more comfortable to explain it now. Clients understand it a little bit better. So we're moving in the right direction.
When I'm looking at standalone policies in this year, have you seen anything emerge as kind of unique? Maybe it's a feature, maybe it's a rider. Have you seen anything emerging in standalone policies?
The one thing that we've seen change is a shift away from the inflation of 5% to a 3% inflation. I think that we tried to get pretty intuitive to what the client was looking for. They wanted to have a cost of living increase, but the 5% compound inflation, which so many were accustomed to, many agents were accustomed to offering, really began a pullback in 2013, and we saw more business roll to the 3% compound. Again, it's an evolution and a step in the right direction.
Do you see COLA? Are they actually using COLA? Do you see that as an add-on? Does most people use it then, even at 3%?
They do, because the clients that we're talking to about care planning primarily are in their 50s and 60s. They probably won't need this until they're in their 80s or 90s. So purchasing a plan today that maybe it's $6,000 a month, well, that won't be enough. We know it won't be enough 20 or 30 years from now. So the cost of living adjustment is important, and it's an important part to the plan.
You just said something interesting, and I don't know if you really, I immediately grabbed it. You said they probably won't need it till their 80s and 90s. When I came into this business, we were all talking, you're going to need this in your early 70s. Are you seeing kind of a pushback down the timeline?
People are living longer. Medicine is advanced. 20 years ago, just like you, we were talking about needing it in their 70s and 80s, and now it's being pushed forward. And that's part of the whole evolving of the industry.
So would LTC actually, is the new 70, 80?
Without a doubt.
Wow.
Without a doubt.
Think about that. I mean, that's you know, you've got these, what I think they're called octogenarians or octogenarians, something like that. They're now the people that we're really targeting on the benefit side, the claims.
Yeah, they are. And, you know, we have to understand this industry. The need has never been greater. Every year, the need gets greater. And though there's some change in the product offerings or the solutions that are out there, what we see come back to us from the marketplace is an uncertainty, really because folks don't understand enough about what's being offered today. And that's not the fault of the consumer, it's not the fault of the agent. As an industry, as a long-term care industry, we have to go out and give the right messaging. We have to explain why we've made the changes that we've made. And it really is to solidify to be here for the long haul.
Remember, we did a huge campaign with Maria, not only on individual, but also in business long-term care. And if you haven't seen those videos, they were really great pieces that really explained so much. I mean, we really got into the weeds on those series. And I really encourage you to go back out to our site, downtobusiness.ashbrokerage.com, and pick up those videos and read them again, because they're really worth viewing. And it kind of gives you an idea. You know, I'm thinking about long-term care and the evolution for this year. How should we position our practice? Because you said we're dealing with seniors.
Yes.
Seniors are going to need, at the minimum now, assisted home living, at the minimum. So how should I position my practice?
So seniors are a very important part of this market. So are the baby boomers, so are the Generation X individuals. And the reason why is because Generation X, children of the boomers themselves, they have had this experience taking care of that older generation for long-term care. And so without a doubt, raise the conversation, ask questions, find out what's happening in that family dynamic today, because more times than not, someone is receiving care on some level. And if we could educate folks at a younger age so they understand what's available in the market, everybody will be so much better off.
One of our largest video blogs that hit our section on Producer's Web was the very thing you talked about, engaging conversations on LTC. Extended care coverage is really huge right now, and I think you really need to encourage your practice to try to bring this into maybe not just an adjunct to your practice, but now this becomes part of your retirement modeling.
Without a doubt.
You know, I'm trying to still encourage most of our advisors. I know how to do asset allocation, I know how to do distribution, but what about protection during the senior years?
Yeah. You know, if you're helping your client build their wealth, part of that is to protect the wealth. And so if you're not asking about long-term care, which could be one of the greatest risks in retirement, we're leaving something important out.
We'll be right back with more from Maria in about 30 seconds. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back, everyone. And Maria, I want to shift a little gears here, but before I head into linked benefits, right,
Yes.
which we've been getting a lot of play on the net, I want to make sure, I just want to make sure, gender, I got the gender thing. We went from
Yes.
unisex rates to separate gender, but not underwriting. And the underwriting didn't change on that, did it?
It did not, and thanks
did
for
not.
bringing that up. It did not. Underwriting, there were changes across the board, but not specific to males
Because
and
of
females.
gender.
Right.
Well, I appreciate that, because just for a second I'm thinking, no, I don't.
Yeah.
Or why would there be a difference? Let's talk about linked benefits. I mean, I know that this is the most popular format right now out on the street from an LTC point of view. Extended care coverage, people love that annuity LTC provision. The Pension Protection Act of 2006 dovetails into
Yes.
annuities that qualify. It's really huge. Talk a little bit about some of the options that are now in 2014 for linked benefits.
Yeah, historically, linked benefit was funded with a single premium. When the products emerged in the late 1980s all the way through probably the early 2000s, we saw a single premium as the main funding source. In the past 12 months, we've seen a shift. More and more linked benefit is being purchased with flexible premium, payment perhaps over 3 or 10 years, even annual premiums. And that has been a very different change for us. Linked benefit went from being take your emergency assets and just reposition all at once to having the ability now to fund premiums over a period of time.
So I want to make sure I understand. So I have flexible payments that could be even monthly payments into linked benefits, like an annuity?
They could be, yes, they could be. And the advantage here is that you're getting the best of both worlds a linked benefit offers. Coverage if you have a long-term care event or a legacy asset in the event of untimely death. And instead of having to come up with a large upfront premium, now there are options out there, and I believe we'll see more to come. In 2014, more options for flexible premium funding, which makes the client or the consumer feel a lot more in control over what they're doing with their premium deposits. Instead of taking $50,000 or $100,000 up front, you have the ability to do it in installments.
Well, I've heard you and Bradley talk about linked benefits as an asset on the balance sheet.
Yes.
And remember, before we got to this, that was weird. I thought we were talking about linked. LTC is indemnification.
Yeah.
Now we're saying, for a linked benefit though, you could position this as an asset. And of course, we ran this on Insmark to show the math behind this, which basically said you should do LTC. There's money in this.
Yeah. Well, there's no denying that care planning provides great reward for the policyholder and for their family. For the insurance professional or advisor or agent that's working with that individual, think about the generational impact that has. When you're helping mom or dad, you're also protecting a lot of their wealth so that if there's a care event, that wealth that had been protected gets passed on to the kids and to their kids.
So besides the fact that we're now being able to actually pay these payments in by the month, what other options have you seen develop with linked benefits?
Well, I think that the inflation options, the cost of living adjustments, they've become better. You know, when linked benefit first came out, there really was not any type of inflation option, and it was a little clunky when it first came to market, but today they're a lot smoother, they're easily understood, and there's a little bit better benefit to premium ratio.
Now, in the first segment, you said the standalone was at 3% now for 2014. What is it over
Well,
at
we're
linked?
seeing the same for linked benefit. I think the 3% option has really grabbed hold.
And is also compounded, not simple?
Correct.
Well, let's shift a little gear here and go to accelerated benefits product,
yes.
because I've always had this query, should I have a mortality product mixing with a morbidity product? It seems antithetical to me.
It's all about options. It's all about giving the client choice. And accelerated benefit is something in the past 12 to 18 months that has really caught some attention in the marketplace. And accelerated benefit is purely that. It's a life insurance solution, and you have an acceleration of the life insurance benefit to help cover chronic illness or cover a care event. It's different from the linked benefit market in this way. The linked benefit products have heavier leverage on the long-term care component. The life insurance aspect to those policies, although a great feature, they're not as competitive as you might find in the accelerated benefit market. So with the accelerated benefit solutions, we have a very competitive life insurance benefit, and if the client has a chronic illness or if the client needs to tap into it for self-expenses, they can tap into that death benefit. The difference there is that primarily once the life insurance component in the accelerated market, once that is exhausted, that's the end of the coverage. But again, one more way that the marketplace has responded by saying, here's another vehicle we can use to help an individual who may need care.
When I'm looking at accelerated benefits with life, we have so many. I mean, there's a lot out there. That menu is huge as far as inventory
And
of
growing,
carriers
and growing, yes.
So somebody must be looking at this and saying, there's a market niche here to pull out. Now, when you look at this, when you're comparing it, do you see people making a weighing decision? Hey, should I be doing life insurance linked benefits with LTC, or should I be looking over here at accelerated benefits with life insurance?
Well, they're looking at it from the standpoint of these are all the options available to me today. And by the way, these options have never been as great as they are today. And if life insurance is the key driver, the accelerated benefit is the way to go. If it's the long-term care leverage, the linked benefit option is the way to go. What we're seeing the consumers respond to is the awareness now that they have more than one way they can go. And that's great for the marketplace. As you may recall in the previous segment, I said to you, the demand has never been greater. And in 2014, we will just see that continue to grow. So it's an exciting place to be in our business.
Well, that's our show for today. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. And don't forget, you can view all our past episodes at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. See you.